What will be the stock price for Taiwan Semiconductor stock in January of 2026? That's 1 year out from today. That's what I'm going to cover in this video. In doing so, I'm going to cover their business model briefly, then I'll go over their financials, and finally I'll do a valuation to show the upside. Let's get started with their business model. Taiwan Semiconductor is the biggest contract chip manufacturer in the world. As you can see on the screen, they make chips for high performance computing, which is AI, then smartphone market, IoT, Internet of Things, automotive, DCE, etc. High performance computing refers to AI, the chips that are designed by the likes of Nvidia and AMD, and the smartphone market, they cater to Apple. Let's get started with their financials. There's a lot of conflicting information on the web, but I'm going to show you the correct information. When I look into the stockanalysis.com, it shows the market cap as $883 billion and the shares out are 25.93 billion. But the stock price is shown as $200, right? So when you multiply 200 with 25 billion outstanding shares, you get $5 trillion. So this is wrong. Now let's move on to what Google is showing. So Google is showing $916 billion. And even that is not correct. The correct one is as shown on the screen. Their current market cap is 1.096 trillion at a stock price of $211.5. Their number of outstanding shares are actually 25.92 billion published on their financial statements. But when you come to the ADRs, American Depository Shares, 5 shares of those is equal to 1. So in a way, they only have 5.19 billion outstanding shares when you take a stock price of $211. So this is the correct financial. $1 trillion market cap, $211 stock price, and 5.19 billion outstanding shares. Let's look at their profit margins. As you can see on the screen, for the past few quarters, their gross margin is about 55% on an average. Their operating margin is about 45% on an average. And look at the net profit margin, that's also 40%-ish. And when you look at the free cash flow margin, that's actually slightly less because this company invests a lot of money in capital expenditure. We know net income minus capital expenditures is free cash flow. So even though they are very profitable, they have to put some money back into the business. So the free cash flow will be lower. And I'll show the valuation considering net profit and also the free cash flow, because the company that we're evaluating is not like a SaaS business. This is capital expenditure intensive industry. So I'm going to show those valuations later. Let's quickly look at how they did in 2024, the entire year of 2024. As you can see on the screen, they made close to $90 billion of revenue, and income from operations, that's the operating income, is about $41 billion. So that's almost like 45-46% operating margin, which is phenomenal. And if you look at income before tax, because we have the operating income, you pay tax and you get net income, right? So income before tax is 43,756 million, so about 43 billion. And the net income is 36 billion. At the bottom, you can see the outstanding shares as 25.93 billion. And now let's look at the cash flow statement a bit more into detail. As you can see, we are starting with the income before income tax. That's what I've shown in the previous snip, $43.7 billion, right? And look at the depreciation and amortization. That's about $20.6 billion. Depreciation and amortization, it's a non-cash expense, right? Because if you own some infrastructure, that's going to depreciate over time, and you have to show that in the operating margin. But that's a non-cash expense, so you can add it back in the cash flows. But when we actually do the valuation, we have to consider that as an expense. We cannot do a number without depreciation and amortization. That's EBITDA, right? And you know what Warren Buffett calls EBITDA? It's the BS metric, and I believe in the same. But anyway, for the purpose of cash flow, I'm showing that they have close to $56 billion of net cash generated by operating activities in 2024. So out of that 56 billion, the capex is 29.7 billion because they are building a lot of factories outside of Taiwan, and that takes a lot of money, right? So that's why their capex is $29.7 billion. This is why we have to consider free cash flow for the kind of companies which have very high capex, right? But remember that even though they have net cash generated by operating activities as 56 billion. Almost half of that is going for the capex. So the remaining, out of the remaining like $27 billion, $11 billion is being paid to the dividend, right? So they will only be left with like 15 billion or so. So understand that even though they make a lot of operating income, they also have capital expenditure and the dividend to pay, and after that they're left with some cash, right? So we have to keep that in mind when we do the valuation. Let's look at their guidance. For Q1 of 2025, they're guiding for $25 billion to $25.8 billion of revenue. That's more than 40% growth year over year, but that is Q1, right? And as they proceed to Q2, Q3, and Q4, that year over year growth is going to reduce because the previous year revenue was also higher. So in the valuation, I'm going to assume only 30% growth. One last thing I want to point out is their capital expenditure for 2025 is $38 billion to $42 billion. So at the midpoint, they're going to spend $40 billion in 2025 for capital expenditure. The biggest worry is they're spending a lot of this money now to build the plants. Let's say in 2026, 2027, AI monetization doesn't happen very well and they get less number of orders. Then what do they do with this newly built infrastructure? That's going to become a huge overhang. That's a bit worrying because for them to do really well post 2026, there has to be very high demand. AI has to be a mega success. Otherwise, they're going to suffer, right? But anyway, our valuation is for Jan 2026, so I'm not going to consider all of that. So let's now move on to the valuation. I'm going to show two cases, one based on net income and the other one based off of free cash flow. I've explained the differences previously, so I'll get started with the valuation. This is not financial advice, so please don't consider it as financial advice. I'm simply recording my thoughts about TSMC. I do not own TSM stock at the moment. So let's get started with the first valuation, which is net income based. In 2024, they made about $88 billion of revenue, or close to $90 billion. So I'm only assuming 30% growth, with which they will make about $114 billion of revenue in 2025. The net profit margin most recently is in the order of 45%. So I'm going to assume the same 45% net profit margin. With that net profit margin of 45%, their net income will be about $52 billion in 2025. I'm assigning a multiple of 30 because currently people are giving it a PE of 30. Remember that Nvidia gets a PE of 50, right? Because they are not investing a lot of money in their capex because they contract the manufacturing to TSMC. But that's not the case with TSMC. They have to put a lot of money back into the business in the form of capex. So they get a lower multiple, and market is paying 30 multiple in 2024. So even in 2025, they may pay the same multiple. That's what I'm assigning here. With that, this company would be worth about 1.5 trillion by end of 2025. And currently they have 5.186 billion outstanding shares. I'm assuming no buyback because they did not do that even in the previous year. They don't have much left. They're putting a lot of money in capex and also dividend payment, right? They're not left with too much of cash. So that's why I did not assume any buybacks. When I divide the 1.5 trillion market cap with 5.186 billion outstanding shares, I get a stock price of $298. Currently they're at $211, right? That's about 41% gain in 1 year, and that's phenomenal. That's very impressive. Now let me show you the other valuation, which is free cash flow based. So free cash flow is net income minus the capital expenditure. So I'm assuming the free cash flow margin of 25%. Recently they had 29%, but their capital expenditure is growing from 2024 to 2025. So therefore the free cash flow margin will be less. That's why I assumed 25%. So with that, their free cash flow in 2025 would be $28.6 billion. So this is the free cash flow. So I can assign a higher multiple because this is the real money that I can see, right? So 50 multiple like Nvidia. So when I apply 50 multiple on $28.6 billion of free cash flow, I get a market cap of 1.4 trillion. So that converts to a stock price of $276. So current price is 211. So that's about 31% gain in 1 year. In both valuations, the upside is phenomenal. 41% in the net income based valuation and 31% in the free cash flow based valuation. So TSM looks like a buy at $211. Again, this is only for this year. We don't know what will happen next year, right? So that's why I think this is a trade for 1 year, and I don't think it's a long-term hold at the moment because there is still a lot of unknowns. They're expanding their capacity left, right, and center, and we do not know whether they will get an opportunity to utilize that capacity or not, because that completely depends on AI becoming a mega success or not. So for me, I may purchase a call on TSM, or otherwise I can capture few shares so I can sell them as a trade in the next few months. So that's my plan. Let me know your thoughts in the comments. Thank you so much for watching.